So what should investors expect from Fed Chair Powell's speech tomorrow? Let's ask Evercore's Roger Altman. It's nice to see you. Thanks for being here, Roger.
Hey, Scott, how are you?
I'm good, thanks. You heard Mr. Harker. We've done enough. You think they have?
Well, I think tomorrow's message from Chair Powell at Jackson Hole is going to be relatively low-key and pragmatic. It's not going to be hawkish in the following sense. I think he's going to say that we've made good progress on inflation, but we have to watch and see if that continues. And he's going to observe, I would expect, that they have to be particularly vigilant because there is stronger underlying growth than most expected and that the Fed expected, and that's a basis for being very watchful. But I don't think his message is going to be one which commits the Fed one way or the other on the upcoming September meeting. It gives them the flexibility to raise again, including then, if the interim data makes the case for that, but doesn't commit them. So a pragmatic, relatively low-key, low-drama message.
Do you think in your gut that September's a live meeting, Roger, or do you think that we get a pause and then we'll put November on the table and just see what the inflation data for what is an alleged data-dependent Fed now sees and thinks?
I think there would have to be some negative data, meaning higher inflation data between now and the September meeting for the Fed to hike then. I think their base mentality is not to do that. As you know, the market doesn't expect rate cuts at all between now and the end of the year. But the big story really is the surprising growth. The latest data suggests that this third quarter may come in about 3% real growth. That is remarkable for this late in the economic cycle. I mean, the recovery began almost 3 years ago today, or this month. And to see 3% growth 3 years later is surprising. I think it's the main reason, probably, why bond yields have risen. It centers around the consumer spending and retail sales. And it's also surprising because there are some considerable signs of economic weakness, but they just aren't showing up in the main growth data. If you look at mortgage applications, you guys have been talking a lot about that. If you look at the flatness in rents now, you look at the China dynamic, you look at certain commodity prices like copper and aluminum, they're suggesting weakness. And I must say, I think it remains to be seen as to whether the recession risk is really behind us. But that weakness is not yet the main event when it comes to the growth data. It's the consumer.
Well, one of the other changes, it appears, is that, as you cite a lot of the positive economic data points and the fact that we're much stronger, I think, at this point, as you suggested, than people thought we would be, that now we've changed things, though, where that good news is perceived bad news because, A, it pushes bond yields higher where they've gone and now makes the Fed a little bit more of a wild card on that whole thing.
Yes, but as you well know, many smart people have already concluded that we're going to see a soft landing, no recession. I mean, the economics department at Goldman Sachs, which I respect a lot, has that viewpoint, for example. I personally think it's too soon to conclude that because monetary policy operates with such long lags, 12 to 18-month lags. And if you look at the speed and the slope of the Fed tightening, and you look at the shrinkage in money supply, M2, you say to yourself, wow, economic weakness is coming. It just isn't here yet. Now, I'm not sure we're going to see a recession, but I don't think it's clear we aren't. It just may be early to mid-24 before we really know the answer to that.